Hey TMFG community, John Yochinette here with Carlo Cancino. In today's episode of Ask TMFG, we're going to be discussing some tax tips you can utilize in today's market to help save you a couple bucks. Remember, if you do enjoy this video, remember to like, comment, and subscribe to the YouTube channel. We love doing these videos for you. In today's episode of Ask TMFG, we're going to be going through some tax tips you can utilize with your investments that are going to help save you a couple extra dollars when it comes time to do your taxes in April. So I'm going to hand it over to Carlo and he can get us started. Carlo?
Yes, thanks, John. What can be done in your portfolio to take advantage of some tax benefits regardless of whatever the market's doing? And especially with the market being so volatile, we want to be able to benefit somehow in this pullback that we're currently seeing. So I'm going to walk through a couple of tips that we can easily get done if you're not already doing with your portfolio. So number one, your management fees. All of the management fees that are calculated on a non-registered account are tax deductible. This means that for every dollar you pay in investment management fees can be deducted from total income on your tax return, therefore lowering your overall income and hopefully saving you some money on your final tax bill. Number two, have your management fees charged on the TFSA deducted from your open account. The benefit being your tax-free savings account is invested in a tax-free environment. You want the investments growing as fast as possible and not hindered by fees that are being withdrawn. If there's any account in your portfolio that you want to be hindered by fees or that is reduced in value because of fees, you want it to be your open account because any investment income earned in the open account is taxable in the year earned. Number three, tax allocating your portfolio components. So I think most of you out there know that different sources of investment income are taxed differently. You've got interest income, dividend income, and capital gains income. Interest income is 100% taxable. So all of the interest income you earn, you have to show on your tax return. Dividends earned, depending on the type of corporation that it's paid by, whether it's let's say it's an eligible Canadian company, you get a dividend tax credit on a grossed up amount. All of that being said is dividends are taxed a little more favorably than interest income. And finally, capital gains income. If you have capital gains, only 50% or half of the capital gains realized are taxable. So you have to put in a lesser amount of your capital gains on your tax return. Knowing the different ways that in different types of investment income is taxed, we can move certain types of investments to different types of accounts. Because interest income is taxed the highest, we want to have the investments that pay interest income in a tax-sheltered environment, whether it be an RRSP, a RIF, or a tax-free savings account. We want to have your interest-bearing investments underneath those registered umbrellas. And for the more favorably taxed investment income, and that would be the equity components or stock components of your portfolio, because they typically pay dividends or you realize capital gains, you want that invested in the open account or the taxable account because they're more favorably taxed. By arranging your investments in that way, you can save income tax in the long run on your portfolio. And lastly, number four, tax loss selling. Now, what we're doing when you tax loss sell is realizing losses on certain types of investments from your portfolio. Now, it's not like we're getting out of the market and staying there and trying to get back in when the market starts to correct. When you tax loss sell, you sell your current investment and you realize that loss, but you buy back into the market into a similar investment that you sold out of. That way you spend almost minimal time out of the market and you can capture market growth as it happens. Now, you have to wait 30 business days from the time that you sold your original investment before you can get back into the original investment. Otherwise, that is a superficial loss and you're not able to use the capital loss. So essentially, we're realizing losses. We're able to put that onto your notice of assessment and carry forward those losses into future years, and you'll be able to offset future capital gains with those capital losses. So those are just 4 tips that you can take advantage of on your income tax, regardless of what the market's doing.
Perfect. Thank you, Carlo. So I really like that last point in regards to tax loss selling, and I know it's something that clients often get misconstrued with because we never want to realize a loss. But like you mentioned, it's making a lateral move from one fund into another fund that's essentially invested the exact same way, so you're never really out of the market. But we do want to realize those losses, just so you have them in your back pocket in the future when you are going to have future capital gains to help offset some taxes for the future. It's just adding an extra tool to the tool belt to help save you some money down the road. But that's another episode of Ask TMFG for today. Remember, if you did enjoy your content, like, comment, and subscribe to the YouTube channel. Until next time, I'm John Iaconetti,
I'm Carlo Cancino.
and this has been Ask TMFG.